Hello and welcome from me, Philip Nothard and Curtis Hutchinson to this special Motor Trade Radio podcast interview. Many thanks again for joining us in this latest in our series of special weekday interviews themed around sharing insight and best practices across the car retailing community.
Today we're delighted to welcome to the podcast for the first time Steve Young, who is the Managing Director of ICDP, the International Automotive Retailing and After Sales Consultancy. Steve will be familiar to many listeners for his unmissable blogs on LinkedIn, which often take a deep dive into hot topics, always with an eye-catching headline. I can recommend his latest post, which is "What if a car was a banana?", which we'll get him to explain in a minute. Regular listeners will also know ICDP from our annual look at the top performing European franchise groups. So Steve's been at the helm of ICDP since 2010, and before that he was the chief executive of LDV Group, where he led the van makers' international turnaround. So welcome to the Motor Trade Radio podcast, Steve.
Thanks, Curtis, and thanks, Philip. It's a pleasure to be here and to have the opportunity for a chat. It's a fascinating industry and a fascinating time that we're in, despite the pressures of lockdowns and uncertainties. It's, I think, going to prove to be a bit of a turning point for the industry. So many thanks for the invitation to join you.
No, you're welcome, Stephen. It's great to finally have you on, and hopefully it will be the start of many opportunities to get you on the podcast. So welcome. I mean, we both enjoy the posts and would highly recommend to anybody listening to the podcast today to head over to the blog section on ICDP on the website there and have a look at some of the blogs that are published by Steve and ICDP on a regular basis. But as Curtis alluded to, let's begin with that banana post that certainly got an interest when that landed on the trend line on LinkedIn earlier this week, and that started from a conversation that the two of us had about the used car stock turn and how dealers would treat their cars differently if they were selling fresh produce. And what's your thoughts on this in relation to both the new and the used cars, especially as we move closer to a showroom reopening in April, Steve?
Yeah, I mean, on the podcast itself, I mean, as you say, there's a lot of stuff on the ICDP website, and some of it is only available to members of the research program. Some of you, if you work for manufacturers or some of the dealer groups, you will find you've got access. But please go there and have a look. In respect of the banana post, the image just came into my mind, and it just sums up so well the challenges that we face, and particularly about used cars, but also about new cars. And I just have this idea that if you had the car sat out on the lot and you put a banana on the bonnet, then the time to sell it is once it's starting to get black and smelly. We don't recognise that the used car is losing value, and more to the point, it's taking up a space that we could put another car in that might sell more easily. And every car brings with it an F&I opportunity, an after-sales customer, hopefully a happy customer who goes and tells their friends about it. So the important thing is the throughput, and it's not so much about the absolute margin you make on the car. You're better to get it through quickly and another one than you are to hold out on the belief that you really think you can get 1,500 or 2,000 or whatever out of a particular car. And the same thing is true on the new car. You might still be talking about it from the point of view of MSRP, but at some point the discount is going to become interest bearing. The discounts are going to start going up. You might or might not get support from the manufacturer to move it on. But no car that's been in stock for more than a few weeks is is a good idea. Thinking about April, then it looks pretty much like we're going to have supply constraints still on the new cars. We all know Sod's law is that the car the customer wants will be the one that's got the supply constraint on it, and the one that you've got in stock is the one the customers don't want. That just seems to be the way of the world. And so, it's important to maximize the opportunities you have from the stock that you have, and to make sure that you treat your customers in a way that will encourage them to hold on if you just can't give them a car just at that moment. On the used side, the supply constraints are there for different reasons, but it makes it even more important than ever that you're proactively going out there, buying the stock that you know you can sell, that you can get a good margin on, turning it quickly and not filling the lot up with more marginal stock that might be available but could also stick around for for 3 or 4 months and lock up the lot.
And Steve, sticking with used cars, I know you haven't any research on this, but I just wondered what your thoughts are regarding the likely opportunities for used car sales post-lockdown, especially in light of the supply issues you mentioned in the new car market. Yeah, we are hearing a lot about potential pent-up demand. What sort of anecdotal evidence are you seeing for or against? What are your views?
Yeah, I mean, I think most of the information that we get, in terms of what's happening in the market today is just from conversations with dealers, and not just in the UK, but elsewhere. And I think that there are customers out there who will be looking for used cars. We know that they're constrained in terms of other ways to spend their money. They feel they owe themselves a treat, and they are still, I think, going to be nervous about using public transport for some considerable time. If we think back maybe even only 3 or 4 months when the vaccine was still in the future, I think we all thought that we're all vaccinated, we're all good to go. And I think that's less clear now, particularly with the issues in Europe. And so people will still be nervous about public transport. I was in London for the first time in a long time, just 2 weeks ago on a Friday, middle of the day, and the roads were absolutely rammed. It was one of the worst journeys I've ever had in and out of London. So people are using cars as opposed to public transport. So I think the demand's going to be there. The supply, less so, because the big companies are holding on to cars. Often the cars have not done much mileage. I was speaking to one of our members the other day, who said she put 3 tankfuls of petrol into her company car in the last year. And so the companies are going to be looking to extend leases rather than turn them in. People are extending their PCPs where they can, where the dealers are willing to let them do that. So the supply will remain limited. And I think the important point is to make sure, again, coming back to this point about active buying or proactive buying, that you've got good relationships with channels that will continue to provide you with good quality inventory in the sort of target area and the mix that you want. If you rely on, no disrespect to Mannheim, but if you rely on going along to the auction and picking up what's left, then I think you're going to be struggling.
And just following on from a point you made there about defleeting, wouldn't some of these big organisations with company car fleets see it as an opportunity to dispose of some of their vehicles because they know that there'll be demand out there and they'll be getting good prices for certainly cars that have had extended contracts. Would you see that happening at all?
I think it will depend on the circumstances internally. I think there's many people who have company cars and therefore have the tax liability, the benefit in kind on the company cars, but who are not doing any mileage, who are actively questioning whether that makes any sense for them to have the car. But in order for a company to sell a car that's provided as part of the employment package, then they need to get their own act together internally first. So I'm fairly certain that over the next, say, 12 months, then we will see a significant reduction in the number of company cars that are being used in the sense of being the offer being taken up by the employee, and so that element will work its way through in time. But I don't think it's going to happen. If we're talking about April-May, then I don't think it's going to happen in that time frame. I think it's much more towards the end of the year, once things start to return to some sort of new normal, and employees and companies come to realize that the attraction of the company car is not as great as it was, and you come to an arrangement to replace that with cash.
Yeah, and I think just adding to that, Steve, I think with one thing that is being talked about a lot at the minute is nobody really understands what behaviours will remain for the short, medium, or long term as a consequence of the 12 months that the sector's just been through. Do we? I think there is a lot of unknowns in terms of that longer impacts, whether that, when you talk about ownership of vehicles, we don't know how many people will continue to work from home, how many people will return to public transport, and how many people will remain in company car contracts or opt out and do alternative things, do we?
No, and I mean, I returned my company car in November last year. It should have been earlier, but a young lady decided to drive into the side of me 4 days before it was due to go back, and I've chosen not to replace it. We're a small business, and so it's easy to make those sorts of decisions on the hoof. Colleagues who still have their cars running, I'm sure will look quite hard at whether they choose to take up the car option when they come up to the renewal.
And thinking about dealer profitability and to get your view on what to expect. I mean, we're looking at 2021, and we know that we're not fully out of the pandemic yet, and there's obviously, you mentioned it earlier about what's happening over in Europe as we're recording this. But what's your view about dealer profitability in terms of can used cars and after sales make good on the potential loss of revenues that would have been happening in new car market through the shortfalls from revenue there?
I think a lot depends on continuing government support. So as a taxpayer, look at the sums of money that are being spent with some horror. But if you look at it in sort of broader societal terms, then it's protected everyone from the worst of what might have happened, or protected the vast majority of people from what might have happened. And my expectation will be that the government will continue to support business and individuals sort of relatively generously compared to what we might have expected of a conservative government, or any government perhaps, by previous standards. So people are not hurting as much as you would think of after all the disruption that we've had. They've not been able to have their holidays. They've not been able to go out to restaurants, not been able to go out to music festivals or whatever, sporting events and so on. And so they've got cash in the bank. So I think they will go out and continue to buy cars. If they can't buy new cars, they'll buy used cars. If they were going to buy a more modest car, then, volume brand, let's say, then you might think, well, you know what, I'll go and buy the premium brand instead. So a bit of sort of trading up in that respect. And again, because they've got the money in the bank, they don't have a financial reason not to continue to have the car serviced. Now, they may also feel that the car hasn't turned a wheel in a year, and so I can get away with skipping a service. But that obviously depends on whether they've got service plans and so on. And the UK dealers have been particularly good, including the used car independents. Done a pretty good job over the last few years about ramping up the penetration of service plans. So there's no financial advantage to the customer of skipping a service under those circumstances, or making a decision to use a lower quality, cheaper part, because it's not their decision in the end. So I think it will work its way through. And we saw on Monday the announcement from Cambria that Mark Lavery and the management team there are considering doing an MBO, doing a management buyout to take Cambria private. Mark and his colleagues are not fools. They're doing it because they think that's a profitable business with a good future that's currently undervalued. And I think that's the story that we've seen repeated across the sector with Marshalls and Virtue and the other groups that have already reported on last year, that it surprised us all, but surprised them as well in compared to their early expectations. But they've actually had a good year, and I think that will probably continue into 21.
Steve, there's growing industry chat about whether we'll see the re-emergence of an agency model whereby dealers are paid a set fee by the OEM for new unit sales. Now, we know that Dash Gupta at Marshall Motors is very receptive to the model. However, in a recent blog, you actually asked if the sector was ready for a 40% revenue cut if it did come back. So what are your thoughts on whether it will come back in some shape or form? And also, is it something we should actually welcome?
Probably worth explaining the 40% revenue cut for those who are not familiar with how agency works. But if you have a new car agency agreement, then the contract for the sale of the car is between the manufacturer and the end customer. And the only revenue that gets routed through the dealer or the agent is the commission on the sale. So they get £1,000 going through the revenue line instead of 25,000 or whatever the number would be. So that's where the 40% comes from. And the reason why I flagged it is because that's going to look, quite significant. And I think if you're a sophisticated, or if you have sophisticated investors, then you can explain that and they can understand that. And from our conversations with equity analysts, then they actually think that's a good idea. They think that rightly or wrongly, they think that our distribution model is broken, needs to be improved. And if someone is doing something significant and dramatic about that, then that's good news. And they'll take the time to understand the 40% revenue reduction. If your finance is relying on a bank manager who doesn't take the time to understand it, all he'll see is the 40% reduction. Or if you're an owner operator who's been going up to the golf course, saying that you've got a £100 million turnover business, and all of a sudden it's now a £60 million turnover business, then maybe your game's going to suffer that day. So it's more of a psychological problem than it is a real problem. The real opportunity is that all your inventory is transferred to the manufacturer, and the risk that's associated with that, and also some other costs depending how it's set up, should also include some coverage of your brand-related facilities and investments. So there's good news. You'll get a better return on a lower turnover and a better return on capital. So we see it as positive. In terms of whether it will come back, we're perhaps guilty in ICDP of having set the ball rolling, because we raised this with our members and to a certain extent with the media a year ago, last January. And we put it out there as a concluding piece of some research that we did called Clean Slate, which you'll also find the report of that on the website. And we said, we don't think many are going to go down this route, but if you were starting with a clean slate, then this is what you might do. And then it went from being something that was a bit out there, a bit extreme, to becoming quite mainstream in a matter of months. And now, obviously the conversations that we have with manufacturers are confidential, but there's certainly a lot of active interest because what agency gives you above all is the ability to legally manage pricing. And so the price on the internet will be the same price from dealer A as opposed to dealer B. And so you shift the focus away from a negative price spiral into hopefully a positive customer service competition. The dealers compete on providing the best service, not on providing the best price. So there's definitely a lot of interest, but it's still worth noting that apart from one or two quite small instances in the Balkans and in Iceland, the only current example of agency applied to a brand fully across the whole of the market is Mercedes in Sweden. And so there's one active case in Europe today. They have announced plans to then launch in Austria, and there's various rumors and stories about other brands who may or may not do something in the coming years. But full agency in the way that we anticipate will survive the current lock exemption review that the European Commission is doing is still relatively rare, but we think it will grow, and we think that it is good news in a objective way for dealers, but lots of smaller owner operators and so on will find that they feel that they've been emasculated. They've had their wings clipped. They're not able to be as entrepreneurial as they were in the past in the new car business. The used cars, the after sales can carry on, but it limits them in the new car business in terms of what they can do.
So, some very good points, as you say. It's, there is the question around turnover, but at the end of the day, it's about EBITDA, the bottom line profitability of these businesses, isn't it? That is key.
Yeah, and if you just do very basic maths, if you cut the revenue by 40% and the deal has been cut in such a way that the commissions just leave you neutral, then very crudely you're going to double your percentage profit, but alongside that will have reduced your risk, reduced your working capital requirements, and so on. So yeah, it's a good news story, but you need to understand it, and the manufacturers need to be fair in terms of how they calculate the commission. If they see it as an opportunity to claw back money out of the dealers without any fair justification, then the dealers quite rightly should push back on that. And if they don't, then they could be left in a worse position.
And sticking with the subject of that relationship between the dealers and obviously the OEMs, and what are the ramifications of Volvo's recent announcement of moving to an online-only sales for their pure EVs, and that's obviously been led by the Care by Volvo subscription offering. What do you see as the sort of implications for dealers, and is this a trend that you think we'll see more of? We've seen it with Polestar Volvo are talking about it, Care by Volvo. What's your view on this around other OEMs?
The announcement said that they were going to go online as they rolled out the pure EVs, and that they were seeking to achieve consistent and transparent pricing. They didn't mention it, but basically that says that they're going agency in parallel to the in parallel to the EV rollout. The actual Care by Volvo element of it, the subscription, then I think that has evolved quite a lot from the initial concept, which was very flexible in terms of how long you subscribe to the car for. And that flexibility has largely been removed as Care by Volvo has itself evolved as an offering, as a product. It was the other part of our clean slate approach, was a repetitive leasing model as well as agency. So we're positive in the sense that we think it's a good way forward for the industry, for the manufacturers and for the dealers and for customers. But we'll be a while waiting. It's not going to happen tomorrow, and it doesn't alter the fact that there will still be used Volvos and a park of Volvos that need to be maintained even as the changes roll through. So we're not talking about a night of the long knives where everything suddenly changes.
And Steve, staying with EVs, we know the clock is ticking down on the government's 2030 ban on new ICE vehicle sales. So how much will the current franchise dealer model have to change to achieve profitability on those EV sales?
If nothing changed, then it does become unsustainable. So even to support one EV sale or one EV coming into the workshop for service or into a body shop, then you need to make investments, you need to train people up. And so you're starting to take on some costs immediately, even while the volumes are low. As things stand at the moment, with the sort of margin structure that you see on a battery electric vehicle compared to a internal combustion engine vehicle, then by the time you get to 100% BEV sales, then the average dealer in our modelling would be loss-making, and obviously some would be deeply loss-making. So that's not a sustainable situation. But the current small margins that are typical on a BEV compared to IC reflect the fact that the product cost is high and the technology is moving on. So the opportunity to rebalance that to some extent is certainly there. And in our modelling, if you make relatively small changes back from the extremely low margins that are common on some brands, back towards, but not necessarily as far as, the margins that you can get on an IC engine car, then you end up back to where we started, along with a couple of other relatively modest assumptions. So 100% BEVs is not an existential threat to the dealer. We can't carry on the trend line that we're on at the moment and expect things to survive with 100% BEV mix. But there's also good reason to say that it doesn't have to do that either, because of the technology development and how that will start to normalise things a bit.
Yeah, like you say, it's some way off, and like you say, in that meantime, there is developments and R&D taking place that the cost and things like this will potentially start to change as we get closer to that 2030 deadline. And as you quite rightly pointed out there's a 36 million used vehicle park in the UK, currently on the roads for opportunities of profitability there as well, isn't there?
Yeah, and the UK dealers are better at used cars than anyone else in Europe, or the vast majority of others in Europe. So they've got a stronger business there, make better returns. They do some of the things that we were talking about earlier on better than their continental cousins. So I think that will play through. And in the end of the day, it's not in the interests of the manufacturers to bankrupt their partners who manage the physical network. They still need physical networks. On agency with online sales, no one is saying you don't need physical partners.
And finally, Steve, if we could take a look at some of the international OEM trends and how they might impact the UK in the medium to long term. So with this in mind, do you envisage some of the new EV brands entering the UK in the run up to 2030? We know there's a number of emergent Chinese brands being talked about, such as Xpeng, BYD, Aywise, Byton, BAIC, and recent talk of Geely's Zeekr premium brand, which is already being touted as a possible Tesla rival. And we've also got Genesis from Hyundai. Can we expect to see some of these brands and others launch here in that sort of timeline? What's your view?
I think we will, and you could add in some of the US brands like Fisker and Rivian potentially coming as well. They will definitely come, and the product now is, I can't talk for all of them, but some of the Chinese EV product is very impressive and competitively priced. So they will come. Will they make their mark at the expense of the existing players? I think they will struggle. I think people are still conservative to the extent of wanting a brand that they know, and it takes time to establish your brand. And you look at the evolution of brands that we now take as mainstream, like Hyundai or Kia or Dacia. It's not something that happens in 1 or 2 years. So I think you combine a technology risk, people nervous about buying an EV, with a brand risk that they've never heard of, Byton for the sake of argument, possibly coming through a channel, or probably coming through a channel that's unfamiliar to them as well. Then I think it will be a tough struggle for them. 1 or 2 will survive for sure. They're huge companies, many of them back in China with strong businesses. But it's not a question of them coming in and wiping out the existing player.
Yeah, potentially smaller supporting franchises against existing franchises, potentially, in the opportunities there. And as you said earlier, the online environment could also be the other offering as well. They don't necessarily need the network infrastructure to come into the UK with an online offering, do they, essentially?
No, and Airways is a case in point, but Airways is already in continental Europe, and they've set up relationships with independent aftermarket players to provide the aftermarket support on an extremely extended service interval. But they're struggling to make headway, and I don't think it's a bad product. I've been to Airways, in China, hugely impressive setup. The people there have got blue chip backgrounds with Shanghai Auto before they set up Airways, but they're still struggling to make any impressions in continental Europe, and having to rethink their approach to try to get the visibility.
Yeah, I mean, there's lots to. I mean, it's what makes these podcasts interesting, and what you do very interesting in terms of what's coming down the line. I mean, we've talked there about dealer profitability, agency modelling, the whole omni-channel, what that means for the sector, the growth of EV, and not necessarily, like you say, the death of the combustion engine, because there's still a huge market to go for, and 2030, albeit is not that long away, it's still a significant time away with the speed in which the sector is evolving. So, I mean, it remains me to thank you for coming on today, Steve, and I'm not expecting to see bananas on the bonnets of too many cars probably immediately, but and sorry for the connection, but it's food for thought to a certain extent. It is, you've got to think about it, haven't you, as we've discussed many times, and it kind of adds that relativity of it, of look at the stock differently and apply it differently. I mean, there's a lot coming to the sector, so lots to talk about, and it's been a pleasure to have you on after such a long time, Steve.
No, that's an absolute pleasure for me as well, Philip, and thanks, Curtis, as well for the opportunity. I'd be happy to join you again in due course, and we'll see what's happened with 2021.
Yeah, no, many thanks for joining us, Steve. And our virtual studio door is always open for you. So do come back and share your views on what's going on in the sector. But unfortunately, that's all we've got time for now. You've been listening to a special Motor Trade Radio podcast interview. Please like and share on social media if you found it useful. We'll be recording more special weekday interview podcasts over the coming weeks and months. Many thanks to you for listening and supporting the podcasts. We'll be back with the industry headlines on Saturday. Until then, it's goodbye from Philip and I.